Hello dear CA final students. In this video, we are going to discuss all the important concepts and the important questions of your IND AS 101. First time adoption of IND AS. First time adoption of IND AS. See, what is this standard? First time adoption of IND AS. See, we have already discussed in class many number of times that nowadays we have this multiple standard scenario. In India, we have multiple standard scenario. Means, what do you mean by multiple standard scenario? There can be lakhs and lakhs of companies in India. Yes, of which those companies having net worth equal to or more than 250 crores are only required to follow IND AS. So very few companies are following IND AS. The rest of the majority is following accounting standards. Correct. So what is the standard? First time adoption. That is our topic. See, for example, let's take X Limited. X Limited is a company. Incorporated, say, for example, in the year 2005. Since then, it was following accounting standards as the net worth is only 100 crores. Current year. What is the current year? Current year is financial year 24-25. Current financial year is, for example, 24-25. 24-25, they have gone for a business combination. They acquired another company. As a result of the acquisition, now this X Limited's net worth has increased from 100 crores to, say for example, it has increased to 350 crores. Now X Limited should prepare financial statements as per IND AS because it has exceeded that limit of 250 crores. Yes or no? Now during this 24-25, they need to prepare financial statements as per IND AS. Now the importance of the standard arises. First time adoption of this IND AS. First time adoption of IND AS. So the question is, till previous year, till the recent financial statement. Recent financial statement is 31st March 24 financial statements. Yes or no? This 31st March 24 financial statements you have prepared following accounting standards or guidance notes, or in general our standard is calling it as previous GAAP. They were following previous GAAP. But now it is a shift to IND AS. So how to do that shift or that changeover? How to do that changeover from AS to IND AS? Now the standard is telling you, if you need to follow IND AS from 24-25 financial year onwards, to make the financial statements more comparable. More comparable means till 31st March 24 you are following accounting standards. All your assets, your liabilities, everything is recognized and measured as per accounting standard. And suddenly the next year you are following IND AS, which means how is it comparable then? Previous year figures and current year figures, how is it comparable? Correct. So what the standard says, if current year is 24-25, where you need to prepare IND AS financial statements, you need to start from previous year? No. You need to start from the beginning of previous year. Oh, this is to have a proper start. If you are preparing a balance sheet on 24-25, there should be comparative figures as per IND AS on 23-24, and there should be an opening balance sheet on 1st April 23. This 1st April 23 will be here in after. In my example, this 1st April 23 will be called as date of transition. This 1st April 23 will be called as date of transition. The entire IND AS is discussing about, this entire 101 is discussing about how to prepare this transition balance sheet. Once you prepare transition balance sheet, then you can follow the principles of all the IND AS and prepare subsequent you can follow other IND AS. So once you prepare this date of balance sheet on the date of transition, all the subsequent financials you can prepare following the respective concerned IND AS. All other IND AS you need to apply. But for this first transition date balance sheet, the provisions are given in IND AS 101. But remember, before studying IND AS 101, you should have an idea about all other IND AS. Okay, because there will be references to other IND AS, so it's better to study this chapter towards the end. Okay.
Come on, I didn't understand anything. Repeat the whole story. Okay, IND AS 101 is first time adoption of IND AS. Okay. This standard lays down the guidelines for initial adoption of IND AS. Understood. It lays down various transition requirements, how to change over. You are not a newly incorporated company. You were following accounting standards for recognizing and measuring all assets, all liabilities, share capital, for everything. You were following accounting standard or guidance note, or we generalize it and call it as previous gap. You were following previous gap. Now there is a transition from this previous gap to IND AS on which date? On the date of transition. On the date of transition, not the year in which standard IND AS becomes applicable. Current year, go back to previous year, beginning of previous year. So 2021-22, IND AS becomes applicable, which means your first IND AS balance sheet will be on, go back to previous year 2021. Go back to the beginning of previous year, 1st April 2020. Oh, your first financial statements balance sheet will be on 1st April 2020, which is called as the transition date. Okay, clear. So how should I prepare the IND AS balance sheet, first IND AS balance sheet? So in the previous gap balance sheet, there is PPE. A 5-year-old PPE is there. We acquired this PPE 5 years back. So the first general principles, and the PPE value is 5 lakhs as per accounting standard 10, AS 10 PPE. Now, IND AS 101, first they are telling all IND AS should be applied retrospectively on the transition date. Oh my God. Retrospectively means go back to that year in which you acquired PPE. And you have to retrospectively calculate the value as per IND AS 16. Oh, then it is a tedious task. Correct. Then intangible asset. Go back to that year in which you have initially accounted this intangible asset. In non-current investments, all assets, all liabilities individually. Say for example, preference share capital. As per IND AS, this is not preference share capital, it is preference share liability, right? If it is redeemable, contractual obligation to pay cash, then it is not preference share capital. Entire accounting will change. Yes, go back to that year in which you issued preference shares. So preference shares can be treated as equity only if it is perpetual or irredeemable or compulsory convertible with discretionary dividend. Correct. So my God, so now it's a headache. Now they are telling, no, read the next sentence. All IND AS should be applied retrospectively on the transition date. However, however is giving us some sigh of relief. However, this standard grants certain exemptions and exceptions from retrospective application. That is why we are smiling. The standard provides some exemptions and exceptions from retrospective application. So the objective of the standard is to prescribe high quality information. Because current year alone, if you provide IND AS figures, then it leads to confusions. So high quality information, that is how this current year figure. Go back to previous year. Okay, again previous year from where this figure came. Then go back to again beginning of the previous year. So it is providing comparable information and with a suitable starting point. Not all of a sudden in the current year, a suitable starting point, and ensure the cost while preparing this cost should not exceed its benefit. Okay, fine. So, fine. The first Ind AS balance sheet which you are preparing, that is on, say, for example, 24-25 is the current year, previous year 23-24, and date of transition is 1st April 23. On 1st April 23, when you prepare the Ind AS balance sheet, the first Ind AS balance sheet should have an explicit and unreserved statement of compliance of all Ind AS. It should be following the provisions of all Ind AS. Your first Ind AS balance sheet should be following all the Ind AS, and partial compliance is not enough. Oh, so first Ind AS balance sheet is the balance sheet on the date of transition. That is my starting point. So first Ind AS balance sheet will be prepared following the provisions of 101, and subsequent balance sheets you have to follow the respective Ind AS. So 101 is providing you, or the entire provisions of 101 is to help you to prepare the first Ind AS balance sheet, that is on the date of transition, and subsequent date onwards you have to follow all the respective Ind AS. Are you clear? Yes. Then how to prepare this first Ind AS balance sheet? Come on. So first Ind AS balance sheet, Ind AS 101 applies to first Ind AS balance sheet and also each interim report during that period. And general principle, first they are telling all Ind AS should be applied retrospectively. So applying all the Ind AS retrospectively, and four, you should remember it as four principles. First one, recognize all. You should remember like this: recognize, derecognize, reclassify, remeasure. Recognize, derecognize, reclassify, remeasure. Recognize all assets and liabilities required as per Ind AS. Maybe as per accounting standards, we won't record it as an asset, maybe like derivative asset, derivative liability, or in-house research expense at the time of business combination. That in accounting standard it will not be recognized as an asset, but recognize in the first Ind AS balance sheet, recognize all assets and liabilities which is not required as per accounting standard but required as per Ind AS. Recognize. De-recognize assets and liabilities which are required as per accounting standard but not required as per Ind AS. That asset or liability is not required as per Ind AS. De-recognize. So how that balance sheet will be tallying now? If you recognize a new item, a new debit came, or a existing debit got de-recognized, all the differences, for the time being you understand, the differences will be adjusted in retained earnings. The differences will be adjusted in retained earnings account. The differences will be adjusted in retained earnings account. Reclassify assets and liabilities. Reclassify assets and liabilities. Example, investment property. Such a categorization was not there, or FVTPL, FVTOCI, amortized cost categorization was not there in accounting standard. But here in the first Ind AS balance sheet, you need to reclassify, remeasure, fair value of a preference share liability, present value of cash outflows expected. That you were not doing in accounting standard, but do it here. Recognize, derecognize, reclassify, remeasure. Okay, fine. Now, see, so how we are going to do all this? So as we said, we have some mandatory exceptions from this retrospective application and optional exemptions. See, you remember it as 10 major points while preparing first Ind AS balance sheet. 10 important points. So that 10 important points we are going to discuss one by one. Be very clear. First one with regard to, so we are starting first point with regard to estimates. Estimates? Yeah, our financial statements uses a greater level of estimates. Most of the items are estimates. Correct. Say for example, there is a provision for bad debt, provision for doubtful debt. See, this estimate is there as per previous gap. Estimates required by previous gap. Yes. There was an estimate of, say for example, 2,85,250. There is an estimate as per the previous financials. I took a random figure 2,85,250. It is an error. Okay, if it is an error in the first Ind AS balance sheet which we are preparing on the date of transition, make estimate reflecting conditions on the relevant date. Make a revised estimate. Okay, because this original estimate is an error. Error you need to restate, you need to correct. Okay, fine. No, it is not an error. Is it consistent with IND AS? Yes, it is correct. As per IND AS also it's correct. Then use the same 2,85,250 in the first IND AS balance sheet. No, it is not consistent with IND AS. There is no error, but as per AS it is correct. But as per IND AS it is not correct. But still you take over 2,85,250 and make the correction in the subsequent financials. You are in the date of transition, right? Date of transition you just take over and make correction in the subsequent balance sheet or financials. Once more quickly discuss estimates. Estimates required by previous gap? No, estimate was not required as per previous gap. There was no provision, but actually provision is required, but they have not created. Then you please create it on the date of transition. On the date of transition, you create if there was no estimate as per previous gap, or revise if the original or the estimate which was already there is an error. Then you have some adjustment. Otherwise, if there is no error, then you just take over and make the correction in the subsequent balance sheet only, which means the moral, or what is the sum up, what is the one liner in estimate. In the previous gap, if there is an estimate, that estimate is wrong, make correction. Otherwise, just take over. It's not correct as per IND AS, it's not consistent with IND AS, fine. If it is not evidencing an error, just take over. And if there is a correction required, make correction in the subsequent balance sheet. On the date of transition, you can just take it over. And if there is no estimate created as per previous gap, then you have to create it. Understood. That's with regard to estimate.
Now, NCI. What is the treatment with regard to NCI? Oh, you are preparing a consolidated balance sheet. Okay. In consolidated balance sheet, there is NCI. In consolidated balance sheet, there is NCI. Okay. Consolidated balance sheet, NCI ഉണ്ട്. So, our NCI, as per accounting standards, first accounting standards, we call it as minority interest. മൈനോറിറ്റി ഇൻട്രസ്റ്റ് ഡെഫിസിറ്റ് നെഗറ്റീവ് ആവരുത്, അങ്ങനെയൊക്കെ AS21 റൂൾസ് ഉണ്ട്. സോ ഹിയർ വാട്ട് ഇസ് ടു ബി ഡൺ, retrospectively ചെയ്യണോ? So what they are telling, provisions of IND AS 110 required to be applied prospectively only. Provisions of IND AS 110 is required to be applied prospectively. എന്ന് പറഞ്ഞാൽ from 110 is to be applied from date of transition only. No need to go back and do retrospective calculation. Company incorporated on 1st April 2000 ആണ്. അപ്പൊ ഇന്ന് 1st April 22 ബാലൻസ് ഷീറ്റ് ആണ് നിങ്ങൾ ഫസ്റ്റ് IND AS ബാലൻസ് ഷീറ്റ് പ്രിപ്പയർ ചെയ്യണേ. 2000 പോയി എല്ലാം ചെയ്തു വരണ്ട. You need to start only from 1st April 22. You need to do from 1st April 22 only. 1st April 22. Okay. Previous gap, whatever is the carrying value of that NCI can be taken over. Previous gap carrying value has to be taken over. But very important, നമ്മൾ അതിലേക്ക് വരണേ ഉള്ളൂ. If a first time adopter, maybe നിങ്ങൾക്ക് ഇത് മനസ്സിലാവില്ല, പക്ഷെ subsequent points കഴിയുമ്പോൾ it will be clear. If a first time adopter elects to apply 103, retrospectively. ചില അതായത് നമുക്കൊരു 5 വർഷം മുമ്പ് ഒരു ബിസിനസ് കോമ്പിനേഷൻ ഉണ്ടായിരുന്നു. 5 years before there was a business combination. ആൻഡ് നിങ്ങൾ അത് റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്തെങ്കിൽ, റിട്രോസ്പെക്റ്റീവ്ലി കാൽക്കുലേറ്റ് ചെയ്തെങ്കിൽ, അപ്പൊ പഴയ NCA ടേക്ക് ഓവർ ചെയ്യാൻ പറ്റില്ല. നാച്ചുറലി ബിസിനസ് കോമ്പിനേഷൻ നിങ്ങൾ റിട്രോസ്പെക്റ്റീവ്ലി കാൽക്കുലേറ്റ് ചെയ്തിട്ടുണ്ടെങ്കിൽ, പണ്ട് 103 ഇല്ലല്ലോ, AS14 അല്ലേ, അപ്പൊ നമ്മൾ NCA ഒന്നും കാൽക്കുലേറ്റ് ചെയ്യാറില്ല. പക്ഷെ നിങ്ങൾ റിട്രോസ്പെക്റ്റീവ്ലി ബിസിനസ് കോമ്പിനേഷൻ അപ്ലൈ ചെയ്തു, അപ്പൊ NCA വന്നിട്ടുണ്ടെങ്കിൽ then this NCA പ്രീവിയസ് ഗ്യാപ്പിലുള്ളത് ടേക്ക് ഓവർ ചെയ്യാൻ പറ്റില്ല. നിങ്ങൾ കാൽക്കുലേറ്റ് ചെയ്ത് തന്നെ വരണം. റിട്രോസ്പെക്റ്റീവ്ലി യു നീഡ് ടു കാൽക്കുലേറ്റ് ആൻഡ് ഡു. ഓക്കെ, അപ്പൊ ദിസ് പോയിന്റ് വി വിൽ ഡു വൺസ് മോർ, കാരണം ആ ബിസിനസ് കോമ്പിനേഷൻ വരുന്നേ ഉള്ളൂ. ശരി, ഓർ ബിസിനസ് കോമ്പിനേഷൻ ഇപ്പൊ തന്നെ ഞാനൊന്ന് പറയട്ടെ. ബിസിനസ് കോമ്പിനേഷന്റെ പ്രൊവിഷൻ എന്താണ്? ഫസ്റ്റ് ടൈം അഡോപ്ഷനിൽ വാട്ട് ഇസ് ദ പ്രൊവിഷൻ വിത്ത് റിഗാർഡ് ടു ബിസിനസ് കോമ്പിനേഷൻ? ഫസ്റ്റ് ടൈം അഡോപ്ഷൻ, IND AS 103 need not be applied to business combination before the date of transition. നിങ്ങൾക്ക് എക്സെപ്ഷൻസും എക്സംഷൻസും തരികയാണ്. പക്ഷെ there are options. If you want to do, you can go and correct. You can go and do retrospective calculation. പക്ഷെ ഇത് ചെയ്യണം എന്നില്ല. Exemptions ആണ്. So here, say for example, you are in 1st April 22. There was a business combination in 2018. There was a business combination in 2014. There was a business combination in 2010, for example. You are the acquirer. Acquirer has acquired a company in 18, 14 and 2010. So first, on 1st April 22, what is the first point given by IND AS 101? IND AS 103 need not be applied. നിങ്ങൾ അപ്ലൈ ചെയ്യണം എന്നില്ല. You need not be applied business combination before the date of transition. 1st April 22 കഴിഞ്ഞിട്ടുള്ള ബിസിനസ് കോമ്പിനേഷൻസ് നിങ്ങൾ 103 അപ്ലൈ ചെയ്താൽ മതി. ബട്ട് ഇഫ്, ഞങ്ങൾ അങ്ങനെ ഒരു ഓപ്ഷൻ തരികയാണ്, ബട്ട് ഇഫ് one business combination is restated to comply with IND AS 103. നിങ്ങൾ ഇപ്പൊ 2014 ബിസിനസ് കോമ്പിനേഷൻ നിങ്ങൾ റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്യാൻ തീരുമാനിച്ചു. You decided to do 2014 business combination retrospectively. Then all subsequent business combinations are to be restated. All subsequent 2014 ചെയ്താൽ കമ്പൽസറി നിങ്ങൾ ഏത് വർഷവും കൂടെ ചെയ്തോളണം. ഒരു സെലക്ടഡ് ബിസിനസ് കോമ്പിനേഷൻസ് മാത്രം റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്യാൻ ഇറ്റ് ഇസ് നോട്ട് പോസിബിൾ. ഇഫ് യു ആർ ഡൂയിങ് 2014 retrospectively, doing business combination, applying 103 on 2014 business combination, then you have to do 2018 also. അപ്പോ അങ്ങനെ നിങ്ങൾ റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്യുവാണെങ്കിൽ നാച്ചുറലി അപ്പൊ ഒരു പുതിയ NCA വരില്ലേ ബുക്സിൽ? Yes or no? You will also business combination step number 5 NCA വരുമല്ലോ. അങ്ങനെ 103 2014 2018 വന്ന അപ്പൊ 110 സബ്സിക്വന്റ്ലി അപ്ലൈ ചെയ്യണല്ലോ. 110 പ്രോസ്പെക്റ്റീവ്, 103 റിട്രോസ്പെക്റ്റീവ്, അത് പറ്റില്ലാന്ന്. കൺസിസ്റ്റന്റ് ആയിരിക്കണം. 103 റിട്രോസ്പെക്റ്റീവ് ആണെങ്കിൽ 110 റിട്രോസ്പെക്റ്റീവ് ആയിട്ട് തന്നെ വരണം. അല്ലെങ്കിൽ നിങ്ങൾക്ക് ഓപ്ഷൻ ഉണ്ടായിരുന്നു, യു ഹാവ് എൻ ഓപ്ഷൻ, ഇതൊന്നും ചെയ്യണ്ട, ഇന്ന് തൊട്ട് തുടങ്ങിയാൽ മതി. അല്ല പോണെങ്കിൽ പോയിക്കോ, പക്ഷെ സബ്സിക്വന്റ് ചെയ്യണം. അപ്പൊ 110 ചെയ്യേണ്ടി വരും. ആർ യു ക്ലിയർ? അസറ്റ്സ് ആൻഡ് ലൈബിലിറ്റീസ് ഒക്കെ ഫെയർ വാല്യൂല് ചെയ്യണം. അതിൽ കുറച്ച് അസറ്റ്സ് ഫെയർ വാല്യൂ, കുറച്ച് അസറ്റ്സ് അങ്ങനെയൊന്നും പറ്റില്ല. ബിസിനസ് കോമ്പിനേഷൻ അസറ്റ്സ് 103 അപ്ലൈ ചെയ്യാന്ന് പറഞ്ഞാൽ എൻറ്റയർ പ്രൊവിഷൻസ് ഓഫ് 103 ഹാസ് ടു ബി അപ്ലൈഡ്. ആർ യു ഓക്കെ? അതാണ് ഇവിടെ തന്നേക്കണേ. NCI നിങ്ങൾക്ക് പ്രീവിയസ് ഗ്യാപ്പ് എടുത്താൽ മതി. NCI actually you need to take over the previous gap carrying value, but if 103 is applied retrospectively, then 110 also should be applied from that date. In such case, previous gap carrying value cannot be taken over. Are you clear? Yes, it is clear. Now, classification and measurement of financial asset or financial liability. What is this classification and measurement of financial asset, financial liability? That is, there are 2 points, classification and measurement of financial asset, financial liability. See, old gapല് amortized cost FVTPL FVTOCA ഒക്കെ ഉണ്ടോ? ഇല്ല. നമ്മൾ ഈ amortized cost FVTOCA FVTPL ഒന്നും ഇല്ല. അപ്പോൾ IND AS 109 is saying you need to classify financial assets, all receivables, investments. You need to classify as amortized cost, FVTPL or FVTOCI on the date of transition. Based on the initial recognition, നിങ്ങൾ ഈ date of transition classify ചെയ്താൽ മതി. IND AS 101 provides an exception to this general rule by requiring that such assessment should be done on the date of you need to ശരിക്കും initial recognition initially classify ചെയ്യണ്ടേ. സോ അവർ പറയാണ് വേണ്ട, നിങ്ങൾ ഏത് ഡേറ്റിൽ തൊട്ട് ക്ലാസിഫൈ ചെയ്താൽ മതി. ഫസ്റ്റ് ടൈം അഡോപ്ഷൻ ആണെങ്കിൽ you need to classify only from the date of transition. You need to do this only from the date of transition. Okay, ഇന്ന് തൊട്ട് FVTOCI, FVTPL, amortized cost classification you need to do. പക്ഷേ if that is the point here, what? It's an important point, classification and measurement. IND AS 109 requires measurement of amortized cost of financial asset or liability using EIR. Yeah, correct. Financial asset, financial liabilities have to be measured. Amortized cost angle you should calculate as per EIR. Correct. As an exception to this general measurement principle, IND AS 101 provides that if it is impracticable for an entity to apply retrospectively, EIR ഒക്കെ അന്നത്തെ, അതായത് എനിക്കൊരു ഇൻവെസ്റ്റ്മെന്റ് ഇൻ ഡിബെഞ്ചേഴ്സ് ഉണ്ട്. ഏത് ഡേറ്റിലാണ്? 2005 തൊട്ടുള്ള ഡിബെഞ്ചർ ആണ്, 20 years ഡിബെഞ്ചർ. ഇന്നപ്പോ 1st April 22 ആണ്. സോ റിട്രോസ്പെക്റ്റീവ്ലി പോയി ഇൻവെസ്റ്റ്മെന്റ് അമോർട്ടൈസ് കോസ്റ്റ് കാൽക്കുലേറ്റ് ചെയ്ത് ഇങ്ങനെ വരണോ? വേണ്ട. നിങ്ങൾക്ക് കാൽക്കുലേറ്റ് ചെയ്യാം. അന്നത്തെ EIR അറിയാമെങ്കിൽ you can go and do the calculation. That day's EIR, 1st April 2005 if you have invested, അന്നത്തെ EIR അറിയാമോ? Then നിങ്ങൾക്ക് ചെയ്യാം. ഓപ്ഷൻ നിങ്ങൾക്ക് വേണമെങ്കിൽ you can do. But if it is impracticable ആണെങ്കിൽ retrospectively, fair value needs to be estimated only on the date of transition. അയ്യോ, അതായത് എല്ലാം പറഞ്ഞു വരുമ്പോ എക്സെപ്ഷൻ ഉണ്ട്. നിങ്ങൾക്ക് എല്ലാം മിക്ക ഐറ്റംസിനും ഫോർ ഓൾ ദ മേജർ ഐറ്റംസ് യു നീഡ് ടു ഡു ദ കാൽക്കുലേഷൻസ് ഓൺലി ഫ്രം ദ ഡേറ്റ് ഓഫ് ട്രാൻസിഷൻ. ആർ യു അണ്ടർസ്റ്റാൻഡിങ്? സോ ഹൗ ടു ഡു ദിസ്? ഇത് എങ്ങനെയാ കാൽക്കുലേറ്റ് ചെയ്യേണ്ടത്? അപ്പൊ നമുക്കൊരു നല്ലൊരു ക്വസ്റ്റ്യൻ ഉണ്ട്, ഇല്ലസ്ട്രേഷൻ 15 which I wanted to do. Illustration 15, 16, 17 ആണ് ഏറ്റവും നല്ല questions. Let me do this illustration 15. Illustration 15 is actually a good question. Can I read this? Illustration 15. On 1st April 2011, okay, Sigma Limited issued 30,000 6% convertible debentures of face value of 100 per debenture at par. Okay, fine. So 30,000 convertible debentures, which means compound financial instruments of face value of rupees 100 per debenture at par. The debentures are redeemable at a premium of 10% on 31st March 15. So I'll definitely count 11, 12, 12, 13, 13, 14, 14, 15. 4 years. Okay, fine. Or these may be converted into ordinary shares at the option of the holder. The interest rate for equivalent debenture without conversion would have been 10%. So you're issuing this debentures on 1st April 11. Details are given. Debentures are redeemable at a premium, or this can be converted after 4 years. The interest rate for equivalent debentures is 10%. Date of transition is on, or date of transition is 1st April 2013. So 2 years before you have already issued the debentures. Such is how Sigma Limited should account for this compound financial instrument. And they have given 6% discounting factors, 10% discounting factors. Okay. So how you should do the accounting? See, I need to classify, you need to split it into, if it is a compound financial instrument, you need to split it into equity and liability or only on the date of transition. Only on the date of transition, you need to split this compound financial instrument into equity and liability. Equity at what value, liability at what value. Now, do you have the information, that is EIR or IBR? EIR concept generally arises when there is transaction cost. Yes or no? EIR concept arises when there is transaction cost. But if there is no transaction cost, IBR is what we'll take. Do you know the IBR on the date of issue? If you know the IBR on the date of issue, so remember, classification is to be done. Classification need to be done only on the date of transition. But measurement, classification and measurement can be done retrospectively. Measurement can be done retrospectively if the rate on that initial issue date, if that is available, you can do retrospective calculation. But if it is impracticable, അന്നത്തെ EIR or IBR calculation is not possible, then date of transition തന്നെ മെഷർ ചെയ്താൽ മതി. പക്ഷെ ഇവിടെ നമുക്ക് തന്നിട്ടുണ്ടല്ലോ 10% ആണ്. കറക്റ്റ്. അപ്പോൾ ഞങ്ങൾ എങ്ങനെയാണ് ചെയ്യേണ്ടത്? അതായത് you are now on 1st April 2013, but go back to 1st April 2011. Information is there, so you are going back to 1st April 2011. On 1st April 2011, if IND AS was applicable, what you would have done on 1st April 2011? Yeah, 1st April 2011, issue proceeds is 30 lakhs. That 30 lakhs will be divided into equity and liability. How much equity, how much liability? First you calculate the liability. How do I calculate liability? 30 lakhs into 6%. Year 1 to year 4, you need to pay 1,80,000 as interest. So 1,80,000 will be discounted using 10%. So we'll calculate 0.91 plus 0.83 plus 0.75 plus 0.68, 3.17. 1,80,000 into 3.17, 5,70,600. And last we need to pay option ആണ്. So 33 lakhs. 30 lakhs pay ചെയ്താൽ പോരാ, you need to pay 33 lakhs. 33 lakhs into 0.68. Into 0.68, that is 22 lakh 44,000. So fine. Initially, your liability is 28 lakh 14,600. Yes or no? Initially, the liability is 28 lakh 14,600. And how much would be equity? Equity is 1,85,400. Okay, because that information IBR or EIR is available on the date of issue, we have gone this retrospective calculation. But this is the balance on 1st April 2011. Date of transition is 1st April 2013. Now you need to calculate this equity will remain the same. 185,400. It will remain the same. But what about liability? Liability will change. If 1st April 11 value is 2 lakh 28 lakh 14,600, what will be the value on 1st April 2013? 28 lakh 14,600 plus. You will unwind using 10% interest. Minus repayment 1 lakh 80. So first year closing balance, this 28 lakh 14,600 plus unwinding interest minus 1 lakh 80,000. It comes to 29 lakh 16,060. Now 29 lakh 16,060 plus 10 percentage minus 1 lakh 80,000, 30 lakh 27,666. This will be the balance if IND AS was applicable from 1st April 11 onwards. This liability balance would have been 30 lakh 27,666. Yes or no? Yes, 30 lakh 27,666. Now 30 lakh 27,666. So the balance of this should have been 185,400 and 30,27,666. So this should be the figure that should appear in the balance sheet. Okay, fine. But what is the book value of this compound financial instrument as per previous gap? As per previous gap, what should be the liability? What would be the liability as per previous gap? Previous gap debenture will be appearing at face value. Correct. And there is premium payable on redemption. Correct. There is premium payable on redemption. What is the treatment of this premium payable on redemption? Premium payable on redemption will be amortized over the period of debentures. So, premium payable on redemption will be, how much is the premium paid on redemption? 30 lakhs into 10%, 3 lakhs. 3 lakhs into 2 by 4 would have been amortized. 3 lakhs is a liability. Of that, 2 by 4 would have been amortized. Balance 1,50,000. Amortized 1,50,000 is appearing as a liability. So at the end of second year, 31,50,000 is the liability appearing in the balance sheet related to this debenture. It's not 30 lakhs. 3 lakhs is also payable. That is also a liability that will be accounted during that 4 years. So 1 by 4 is recognized. 1 by 4 is recognized. So the 2 years has passed. 11, 12, 12, 13. So 31,50,000. So cancel old liability 31,50,000. Recognize new liability 32,13,066 and difference will be transferred to. Difference would be transferred to retained earnings. So is that correct? Yes. So here what they have given, the carrying amount of debenture on the date of transition under previous gap. Interest accrued other than premium on redemption would be paid. So it is 3 lakhs plus this premium. Premium payable on redemption is being recognized as borrowing cost under previous gap on straight line basis. Okay, it will be added. It is added over 4 years. Now, as per IND AS, now they have done the calculation and debt and equity. Initially, what is the value? And they calculated the amortized value at the end of 2 years. So the amount to be recognized, therefore this is the treatment. Therefore on transition date, recognize carrying value of debenture as 30,27,666, recognize equity as 185,400, de-recognize 31,50,000. So there will be a difference 63,066. Is it correct? 30,27,666 plus 185,400. Total we said 32,13,066 minus 31,50,000. So difference will be debited to retained earnings. Are you okay? This is actually a good question. Yes. Now, okay. We are coming to that. The investment ഒക്കെ നമ്മുടെ ഓർഡറിൽ ഇപ്പൊ it's coming. ഇപ്പൊ വരും. Now, um, next, we'll be discussing it soon. ഓർഡറിൽ തന്നെ പോട്ടെ എന്ന് വിചാരിച്ചാണ്. Next is government loans. Treatment of government loans. What is the treatment of this government loans? Again, ഭയങ്കര easy point ആണ്. Just you need to study. What is this treatment of government loans? Listen here. See, actually give me an idea. What is this point? IND AS 20. As per IND AS 20, if there is a government loan at a concessional interest rate, then you need to calculate present value of cash outflows as per market rate of interest. You need to calculate. Correct. Present value of cash outflows as per market interest rate we will do. So we will calculate the fair value of loan and difference will be treated as government grant. As per IND AS 20, if there is a government loan at a concessional interest rate, you will calculate the government loan at fair value, present value of cash outflows discounted using the market rate of interest, and the difference will be recorded as government grant. അങ്ങനെ ചെയ്യണോ? Government loan ഉണ്ടെങ്കിൽ do we need to do this? Yes, provided that market interest rate on the date of loan is available, or else prospectively. മനസ്സിലായില്ല. Listen. IND AS 109 contains principles of classification of a financial asset. Okay, amortized cost, fair value through modify. That point we have already read. Here, what is given? An entity may apply the requirements in 109 fair value of government loan calculation and IND AS 20 retrospectively ചെയ്യണം. എപ്പോൾ retrospectively ചെയ്യണം? Now important, listen. If the government loan originated before the date of transition, of course, date of transition മുമ്പാണ് government loan നിങ്ങൾക്ക് കിട്ടിയേക്കുന്നത്. Provided what? Provided the information needed to do so had been obtained at the time of initially accounting the loan. ലോൺ ഇനീഷ്യലി നിങ്ങൾക്ക് കിട്ടിയില്ലേ? ലോൺ കിട്ടിയത് ഏത് ഡേറ്റിലാ? 1st April 2017 നിങ്ങൾ ലോൺ എടുത്തത്? അതെ. ഇന്ന് 1st April 22 ആണോ ഡേറ്റ് ഓഫ് ട്രാൻസിഷൻ? അതെ. 1st April 2017 മാർക്കറ്റ് റേറ്റ് അറിയാമെങ്കിൽ 1st April 2017 പോയി ഫെയർ വാല്യൂ ഓഫ് ലോൺ കാൽക്കുലേറ്റ് ചെയ്യണം. അപ്പൊ ഡിഫറൻസ് ഗവൺമെന്റ് ഗ്രാന്റ് ആക്കാം. പക്ഷെ അന്നത്തെ മാർക്കറ്റ് റേറ്റ് അറിയില്ലെങ്കിൽ നിങ്ങൾ അത് റിട്രോസ്പെക്റ്റീവ് കാൽക്കുലേഷൻ ചെയ്യണ്ട. പിന്നെ എന്ത് ചെയ്താൽ മതി? ജസ്റ്റ് യു നീഡ് ടു ഡു പ്രോസ്പെക്റ്റീവ് കാൽക്കുലേഷൻസ്. ഇന്ന് തൊട്ട് കാൽക്കുലേഷൻസ് ചെയ്താൽ മതി. അന്ന് അറിയാമെങ്കിൽ മാത്രം യു നീഡ് ടു ഡു ദ സ്പ്ലിറ്റ് അപ്പ് ആൻഡ് ഡു ദ റിട്രോസ്പെക്റ്റീവ് കാൽക്കുലേഷൻ. ആർ യു ക്ലിയർ? നോ, എനിക്ക് ക്ലിയർ ആയില്ല. ഓക്കെ, നൗ ജസ്റ്റ് ഒരു വൺ മോർ ലെറ്റ് മീ റീഡ് ദിസ് ആൻഡ് ക്ലോസ്. ഡീംഡ് കോസ്റ്റ് അല്ല, ഗവൺമെന്റ് loan. A first-time adopter shall classify all government loans received as a financial liability, okay, in accordance with financial instruments. A first-time adopter, this is the point, shall apply the requirements of 109 and 20 prospectively, date of transition onwards ചെയ്താൽ മതി, to government loans existing at the date of transition, shall not recognize corresponding benefit as government grant. Government grant ആയിട്ടൊന്നും റെക്കോർഡ് ചെയ്യണ്ട. പ്രോസ്പെക്റ്റീവ്ലി ചെയ്താൽ മതി. അയ്യോ, ഇപ്പൊ കുറച്ചു മുമ്പ് പറഞ്ഞത് റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്യണം എന്നല്ലേ? ആ റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്യണം. എപ്പോ മാത്രം റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്യണം? So that is what they have given. An entity may apply the requirements retrospectively before for government loan originated before the date of transition, provided the information needed to do so had been obtained at the time of initially loan എടുത്തപ്പോഴേ ഇത് അറിയാമെങ്കിൽ retrospectively ചെയ്യണം. അതല്ലെങ്കിൽ retrospectively ചെയ്യണ്ട. Are you clear? Same as financial liability. അതെ, ഞങ്ങൾക്ക് ഫെയർ വാല്യൂ അന്നത്തെ മാർക്കറ്റ് റേറ്റ് ഓഫ് ഇൻട്രസ്റ്റ് അറിയില്ലെങ്കിൽ പിന്നെ എങ്ങനെ റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്യും? ഡേറ്റ് ഓഫ് ട്രാൻസിഷനിലെ മാർക്കറ്റ് റേറ്റ് എടുത്ത് റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്യാൻ പറ്റില്ല. ഡേറ്റ് ഓഫ് ട്രാൻസിഷനിലെ മാർക്കറ്റ് റേറ്റ് എടുത്ത് റിട്രോസ്പെക്റ്റീവ്ലി ചെയ്യാൻ പറ്റില്ല. ആസ് സിമ്പിൾ ആസ് ദാറ്റ്. അപ്പൊ ഇതൊക്കെ ഇതിനെ റിലേറ്റഡ് ആയിട്ടുള്ള ക്വസ്റ്റ്യൻ ഉണ്ട്, നല്ല ക്വസ്റ്റ്യൻ ഉണ്ട്. അതാ ഞാൻ പറഞ്ഞ 15, 16 ടെസ്റ്റ് ചെയ്യാനുള്ള ക്വസ്റ്റ്യൻസ് ആർ ഓൾ എക്സാം ടൈപ്പ് ഓഫ് എക്സാം സ്റ്റഫ് ഉള്ള ക്വസ്റ്റ്യൻസ് ആണ്. Okay, fine. So government loan is again an important point. Business combination നമ്മൾ already പറഞ്ഞു. Now business combination related questions ഉണ്ട്. So that we'll take business combination. Business combination you need to study this one also. Listen, ഒന്ന് ശ്രദ്ധിച്ചേ. If you are deciding to restate past business combinations, okay. Previous asset or liability recognized as per previous gap. Previous gap വെച്ചൊരു അസറ്റ് അല്ല, IND AS വെച്ചു അസറ്റ് അല്ല. അപ്പൊ പിന്നെ വലിയ നേരത്തെ അസറ്റ് അല്ല, ഇപ്പോഴും അസറ്റ് അല്ല. അപ്പൊ പിന്നെ വലിയ പ്രശ്നങ്ങളൊന്നും ഇല്ലല്ലോ. നേരത്തെ അസറ്റ് അല്ല, 101 വെച്ചു അസറ്റ് അല്ല. ഓക്കെ, ഫൈൻ. It was not an asset before, But as per IND AS, it is to be. ഞാൻ 103 retrospectively ചെയ്യുവാണ്. AS വെച്ച് അസറ്റ് അല്ല, IND AS വെച്ച് അസറ്റ് ആണ്. അങ്ങനെ ഒരു ഐറ്റം ഉണ്ടോ? ആ ഉണ്ട്. ഇൻടാഞ്ചിബിൾ അസറ്റ്സ്, ഇൻ-ഹൗസ് പ്രോസസ് റിസർച്ച്. IND AS 103 പറയുന്നില്ലേ അസറ്റ് ആക്കണം എന്ന്? ആ കറക്റ്റ് ആണല്ലോ. ശരിയാ. അല്ലെങ്കിൽ കണ്ടിൻജന്റ് ലയബിലിറ്റി. മുമ്പ് കണ്ടിൻജന്റ് ലയബിലിറ്റി നമ്മൾ എടുക്കില്ല, പക്ഷെ ഇവിടെ IND AS 103 പറയുന്നത് ടേക്ക് ഓവർ. അപ്പോ ഓപ്പണിംഗ് IND AS ബാലൻസ് ഷീറ്റിൽ അസറ്റ് വരുമോ? യെസ്. അപ്പൊ അസറ്റ് വരുമ്പോ കറസ്പോണ്ടിങ് എന്ത് ചെയ്യണം? അഡ്ജസ്റ്റ്മെന്റ് ഷുഡ് ബി ഗിവൻ ടു റീറ്റെയിൻഡ് ഏർണിംഗ്സ്. അതിപ്പോ അറിയാവുന്നല്ലേ, പിന്നെ ഇപ്പൊ എന്താ ഇതിനകത്ത്? ഓക്കെ. അപ്പൊ ഒരു ലയബിലിറ്റി വന്നു ഓർ അസറ്റ് വന്നു. അപ്പൊ അത് IND AS വെച്ച് അസറ്റ് ആണ്. സോ അസറ്റ് ആയിട്ട് റെക്കോർഡ് ചെയ്യൂ. അപ്പൊ പ്രീവിയസ് ഗ്യാപ്പ് വെച്ച് ഡിഫറൻസ് വന്നു. ഓക്കെ, സോറി. Fine. Okay, now listen. It was not an asset or not a liability as per. I never knew that. I thought everyone is comfortable with this Malayalam also. Okay, now I'll be careful. So it is not an asset, not a liability as per previous gap. Not an asset, not a liability as per previous gap. Like a contingent liability, not a liability as per previous gap. But 103 requires you to take over and show it as a liability. Correct. So there is a difference between previous gap and current IND AS balance sheet. Yes, of course, there is a difference. Adjust in retained earnings. Fine, that I already know. Now, second one. It was not an asset before. And it is an asset now. And this asset is an intangible asset. In-house process research. Intangible asset. Now the difference should be accounted not in retained earnings but in only at the time of business combination. If it was not an intangible asset, then liability or any other asset adjust in retained earnings. But if it is an intangible asset, adjustment should be in a new intangible asset came which was not there in the previous gap. Adjustment should be in goodwill. Did you get that? No. Previously it was an asset. As per previous gap it was an asset. Now as per IND AS it is not an asset. Just ulta, reverse situation. Previous gap it was an asset. Now it is not an asset. So you are cancelling an asset, right? Yes, I am cancelling an asset. Is that asset an intangible asset? Now, is it a intangible asset? Two cases are. There are two cases. Is it an intangible asset? Yes. Then adjustment should be towards goodwill. Okay. So previous gap and IND AS relating to business combination. First case intangible asset created. Second case intangible asset derecognized. The corresponding difference is not to retained earnings but to goodwill. Are you clear? Then the rest actually, other than intangible asset cases, difference to retained earnings. But intangible asset scenarios, it should be adjusted in goodwill and not to retained earnings. Are you okay? I'm not asking whether it is okay. You should study. Okay, fine. In both scenarios, if it is affecting an intangible asset, it should be adjusted in goodwill. If it is not adjusted in intangible asset, the adjustment, the difference is to retained earnings. Okay. Then that I'll read all this theory, small questions. If we have time, not apply. Now, very important point is this question is question number 7. Share-based payment transactions. Share-based payment transactions. What do you have to say about this share-based payment transactions? See, there is a share-based payment reserve as per previous gap. Or ESOP outstanding account as per previous gap. Okay, which means if there is share-based payment reserve or ESOP outstanding account on vested options. What do you mean by vested options? Vesting period has already ended, but it is not exercised. Vesting period ended, All the expense, all the options are to be or to be exercised, but exercise period is after 1 year or exercise period is after date of transition. So നമ്മൾ already so here if you have 1000 vested options, entire vested options would have been measured as per previous gap following intrinsic value. Yes or no? IND AS is following fair value. Fair value means fair value on the grant date you need to measure. What do you mean by fair value on grant date? Expected market price. Expected market price on exercise date minus exercise price is the fair value. And what is intrinsic value? Intrinsic value is grant date market price minus exercise price. As per previous gap, guidance not, we were following intrinsic value. So on vested options, they have already measured the expense or already measured the share-based payment reserve based on intrinsic value. And now you are shifting to IND AS. So in IND AS, definitely what you need to follow is fair value. Do I need to apply IND AS 102 retrospectively? This line I want you all to study. A first time adopter. A first time adopter is encouraged but not required to apply 102 to equity instruments that vested before the date of transition. If it is already vested before the date of transition, you are encouraged. You can do. It's an option. You are encouraged to do but not required. You can do if you want, but it is not required. That vested options can continue at its intrinsic value, can continue. Now, there is one exception. However, if a first time adopter may apply 102 for this vested options if it has disclosed publicly the fair value of those equity instruments determining at the measurement date. That is, you have measured expense at intrinsic value, but you have already disclosed the fair value. You have already disclosed the fair value. Fair value has been disclosed, but was measured at intrinsic value. And it can be remeasured at fair value if you want to. Okay, fine. Vested options, there is an option. There is a exemption. Vested means already you satisfied the conditions. You need not remeasure. Pakka. Non-vested options. If it is non-vested options, apply IND AS 102 from the date of transition. You should remeasure from intrinsic value to fair value on non-vested options, and the differences should be adjusted in retained earnings. Differences should be adjusted in retained earnings. Okay, fine. So this illustration 7 is good, and corresponding adjustments are there in 15, not 15, 16, 17. Let me see. X Limited is a first time adopter of IND AS. Date of transition is 1st April 2011. It has given 200 stock options to its employees. Good. 200 stock options. Out of the 75 options are vested. And remaining options will vest on 30th November 2011. So on 1st April 2011, the 75 options are already vested on 30th November 2010. Before the date of transition, it is vested. So what you should do? So just a theoretical understanding. As per IND AS 101, first time adopters encouraged but not required to apply 102 before the date of transition. However, if a first time adopter elects to apply, if you want to apply 102, then it may do so only if the entity has disclosed. Okay, if you want to do, you can do only if you have disclosed the fair value. Okay, so having regard to, so what is the answer? 75 options. To apply 102, you should have disclosed the fair value. Okay, you should have disclosed the fair value, then only you can apply retrospectively. Then for the remaining 125 options, X Limited need to account the same as per 102 on the date of transition. Retrospectively, not required. On the date of transition, you need to measure. Fair value and measurement date mean fair value of measurement date mean date of transition means no. Initially you determined intrinsic value. So maybe this option is from 2010. 2010 not required. 2020. You are in 1st April 22. So vesting period was 2 years. Okay, 1st April 2020 is the grand date. So 21, 20, 21, 21, 22. 2 years. See 2021 you have already recognized the expense based on intrinsic value. 21, 22 also you have recognized expense based on intrinsic value. Now in 2020, 21, 31st March 21 itself in the notes you have disclosed the fair value. 21, 22 also you have disclosed the fair value. If that is the case, then you can do retrospectively using fair value. You are encouraged to, but not required to, but you can apply IND AS 102 from this date onwards, 2021 onwards. But you can do retrospective calculation only if you have disclosed fair value. If you have not disclosed fair value, you cannot apply 102 retrospectively. Is that clear? Yes. Now, so as I said, all these points, the questions on all these points are there. So please wait. Let me finish off the theory. Now, deemed cost, which is again very important. What is this deemed cost? Deemed cost, PPE, intangible assets, ROU assets, PPE, intangible assets, leased assets. ROU assets means leased assets. For PPE, intangible assets, ROU assets, can I go back on the date when asset is purchased and retrospective calculation as per IND AS 16? Should I do? Okay, you can do. As per IND AS 101, there are three options given. For these three items, PPE, intangible assets, ROU assets, there are three options. You can either go for retrospective calculations. Okay, as per IND AS 16. Or you don't want to do retrospective calculation. Then you take this assets at fair value on the date of transition. Oh, don't do retrospective. Today's fair value. On the date of transition, what is the fair value? Okay. Or you take over previous gap carrying value. This fair value on the date of transition or previous gap carrying value will be considered as deemed cost on the date of transition. Just take over. You have given option. Oh, okay. Good. So we have options. Correct. Listen. Deemed cost of PP, intangible assets, ROU assets. Entity has the following options with respect to PPE as per IND AS 1638 or IND AS 116 in the opening IND AS balance sheet. Measurement basis you can do retrospectively. On item by item basis, you do retrospective calculation. If you would like to do that, please do it. Plan A as per IND AS 16, Plan B, fair value. So you can go for item by item basis. You can select. If you want to do retrospective, you do on one asset. You want to take fair value of another asset, you take. So that's possible. Fair value at the date of or you take fair value at the date of transition. This also can be applied on item by item basis. Some assets you take retrospective, some assets you do fair value. That's possible. Previous gap carrying amount. This measurement option. Okay, fine. Understood. So, but here there is an exception. So, don't take it as for all assets, all PPE, all intangible assets, ROU assets. Retrospective calculation is there on item by item basis or fair value of date on transition or previous gap carrying value you can take over provided for investment properties. Previous gap carrying value you can take over but fair value cannot be taken. What is this? Investment property permits only cost model. Therefore, option of availing fair value on the date of transaction as deemed cost is not available. Correct, no? Fair value on the date of transaction, that is not possible. Okay, fine. Deemed cost exemption is possible. And here you have some questions like, what if there is a business combination? There is a business combination. All PPs are acquired as in a scheme of business combination. So, and you decided to do business combination retrospectively. Can you avail this deemed cost exemption? You are revaluing, you are restating business combinations retrospectively. Then can you avail this deemed cost exemption? No. If business combination is availed retrospectively, then all assets should be measured on that date at fair value. Then it should be depreciated, and now it is to be retrospectively calculated. Deemed cost exemption of fair value on the date of transition, previous gap carrying value, simply taking over, that provision will not be available if you are going to restate business combination retrospectively. So if business combination doing retrospectively, NCI retrospectively, 110 full retrospectively, fixed assets, PPs, whatever assets you have acquired in a scheme of business combination should be calculated retrospectively. This option will not be there. Did you understand? Hopefully, yes. Now 8, 9, 10. Three more points. Listen. Cumulative translation difference or long-term foreign currency monetary items. See, what is this? See if there is a cumulative translation difference. What is this cumulative translation difference? I don't know. Cumulative translation difference. See, if you have a non-integral as per AS 11, previous gap, if you have a non-integral foreign operation, when you translate the trial balance, correct, non-integral foreign operation, you have a foreign branch which is non-integral. I will be translating the trial balance to reporting currency, and there is a translation difference. It will be taken to FCTR. Integral means that exchange gain or loss would be transferred to P&L. Integral as per IS 11, if it is integral, the difference will be to P&L. Non-integral, the difference will be to FCTR. Okay. So recognize some, no need to recognize the translation difference in OCI. Reclassify cumulative translation difference to P&L as part of gain on its disposal. So what is this? If first time adopter uses this exemption, understand, if there is an FCTR balance already as per AS 11, 5 lakh balance is there. Based on the previous non-integral foreign operation translation difference is there. It can be set to 0. Because there is no non-integral. For integral and non-integral here in IND AS 21, same treatment is there. So you set whatever is there in FCTR 2. So yesterday FCTR balance was 5 lakhs. In the current first IND AS balance sheet, you can set it to 0. For all foreign operations, 0 and start fresh. Then from the date of transition, apply IND AS 21. Okay. So gain or loss on subsequent disposal of foreign operation shall be naturally, if FCTR balance is 0, then reclassification to P&L will not be there. Nothing. You can, a first time adopter shall set cumulative translation difference to 0 for all of foreign operations. So difference, if there is FCTR credit balance, it will be transferred to retained earnings. Okay, fine, understood. And long-term foreign currency monetary items. Very similar treatment, accounting treatment. Say for example, You have studied as per AS 11. If there is a long-term foreign currency loan, this is the rule. If there is a long-term foreign currency loan, this is as per AS 11. If there is a long-term foreign currency loan, which has to be divided as per AS 11 into acquired for depreciable asset, acquired for depreciable asset, other purpose. You acquired for some other purpose or acquired for depreciable asset. If it is acquired for depreciable asset, if there is a long-term foreign currency loan, this loan fluctuations of loan can be, if there is a loss, foreign currency liability has increased and there is a loss, loan, 5 lakh dollars you have taken loan at 40. Now it is year end closing rate is 45. So there is a loss of 5 lakhs into 5, 25 lakhs loss can be capitalized to the asset. It can be capitalized to the asset, added to the carrying value. For other purpose, if you have taken a loan, for other purpose, not for depreciable asset, this fluctuations, not for depreciable asset, this fluctuations can be transferred to an asset, a new reserve item called FCMITD account. Foreign currency, monetary item, translation difference. Foreign currency, monetary item, translation difference. So, but these treatments are not there. This is given in paragraph 46, 46A as per MCA notification. But these treatments are not there in IND AS 21. So previous gap it was capitalized. Previous gap there is FCMITD, but such treatments are not there in IND AS. Then what you should do? So there are two options again. First option number one is whatever balance is there in FCMITD. So for option number one, continue old practice. You don't need to do any adjustment. Continue old practice for old loan. Till that loan is derecognized, you continue the old practice. So there won't be any change. Continue old practice for the old loan, not for the new loan. Continue old practice for the old loan. Or second point is, if there is a balance in FCMITD account, again set to 0 and start applying IND AS 101 prospectively. Did you understand? So what are the two options available? Notified that they are explaining that point. A first time adopter may continue the accounting policy adopted, either continue the old policy adopted for accounting of exchange differences from the beginning of first IND AS. As per previous gap, you continue because such a rule concept is not for us, but you continue for the old loan, not for new loans. For old loans, you can continue. Which means this exemption is not a permanent exemption. Only for that particular loan, that exemption is available. Okay. Or what you can do is, for here example is given, such recognize transition date, the first reporting date, the exemption is available only if such monetary items was recognized as per. Okay, fine. That is what explained. Or else you can do it, you can set to 0 and start applying the new practice prospectively. Now there is investment in subsidiary. Like what is the treatment of investment in subsidiary, investment in joint venture, investment in associate? What is the accounting treatment? In the separate financial statements, there will be an investment account. So what is the treatment? IND AS 27. As per IND AS 27, investment in subsidiaries, joint ventures and associates can be either measured at cost or in accordance with 109. That is either at fair value or through OCI, P&L. You can measure the investments at cost or you can measure the investments at any of this as per 109. So what about 101? What about 101? 101, again they are telling you record the asset investment. Maybe in previous gap it is appearing at cost. You can continue at cost or deemed cost. What do you mean by deemed cost? Fair value at the date of transaction is deemed cost, or you take previous gap carrying value. So either, so investment in subsidiary, associate, joint ventures can be either taken over at a previous carrying value or cost determined as per 127 or deemed cost. Exemption is available. Oh, easy. But this related question is also there. I mean, adjustments are there on relating to these points. Okay. And very important is this joint arrangement. Joint arrangement in days 111. See, previously it was in the accounting standard 27. If you have a joint venture, you should do proportionate consolidation. You should do proportionate consolidation as per AS 27. If there is a joint venture, now in intermediate there is AS 27, but for you, you have not studied. So proportionate consolidation, and in days 111 says if it is joint arrangements and joint venture as per Ind AS 28, it should be accounted as per equity method. Equity method. So what you should do from proportionate consolidation to equity, measure the investment at transition date at the aggregate of carrying amount of assets and liabilities, including goodwill. And you test for impairment if there is an indicator. So what is this? Let's try a question and find out. So this related question also we'll try and we'll find out what the treatment is. Okay, let me quickly take two few study material questions. X Limited is required to adopt IND AS from 1st April 2011. So which means 11-12 is the year in which IND AS is applicable. Correct. With comparatives for 1 year. When you prepare the IND AS for the first year, you need to provide comparatives. Correct. 10-11. So what is the date of transition? Do you need to start from 10-11 onwards? You should say no. You should start from 1st April 2010 onwards. 1st April 2010 onwards. Correct. You need to prepare not from 10-11 onwards. There should be a third balance sheet. The starting point should be 1st April 2010, then 31st March 11, then 31st March 12, so that the users will be comparing or users will be getting a good starting point. Yes or no? So they can make decisions based on that, or they can compare the previous years and starting point. Okay, fine. Now the same thing. Example. And this question is actually not at all difficult, but let me read this. Company B is a foreign subsidiary of company A. So there is a company A and there is company B. Company B is the foreign subsidiary and has adopted IFRS as issued by IASB as its primary gap for its local financial reporting purpose. So there is company A and company B is the subsidiary, and company B is following IFRS as issued by IASB for and its as its primary gap. Company B prepares its financial statements as per accounting standards specified under in section 133 of Companies Act. Fine. On transition of company A to IND AS. So A is there is a transition from previous gap to IND AS. What would be the previous gap of foreign subsidiary for its financial statements? What will be the previous gap? So, company preparing financial statements in accordance with accounting standards, this is the previous gap. So, financial statements are prepared by company A and company A will be consolidating company B also. So, they are following accounting standards specified under section 133. So, what is the previous gap? That shall be considered as the previous gap. Accounting standard following, I think, accounting standard on the previous gap. Okay. Then, so this I'm not reading. Or I'll read this one also. Maximum questions I'll try to read. E Limited is required to first time adopt IND AS from 1st April 2011. The management of E Limited has prepared its financial statements in accordance with IND AS, and an explicit and unreserved statement of compliance with IND AS has been given by the management. Now, E Limited is a company required to prepare IND AS for first time. Okay. And management has prepared and they have given an explicit and unreserved statement of compliance with IND AS. However, there is a disagreement on application of one IND AS between management and auditor. Regarding one IND AS, the treatment is not correct according to auditor. So, can financial statement be treated as first IND AS financial statements? To be treated as first IND AS financial statements, what is the rule? To be treated as first IND AS financial statements, the financial statements should comply with all the IND AS and the management should provide explicit and unreserved statement of compliance. Now, the disagreement with auditor is a different story. If auditor is not happy, let him qualify the report. That's it. Still, that first IND AS balance sheet will be treated as first balance sheet as per IND AS. Okay, I'm reading this question number 13. Okay. Um, Y Limited is a first time adopter of IND AS. Date of transition is 1st April 2015. On 1st April 11, it obtained a 7-year US dollar loan of 7 years. It's US dollar 1 lakh. It has been exercising the option provided in paragraph 46-46 AS11 and has been amortizing the exchange differences in respect of this loan over balance period of such loan. Okay. On the date of transition, company wants to continue the same policy with regard to amortizing. Oh, that's why I'm saying the theoretical questions are very much okay. Just go through. So, can they continue with the same accounting policy? Old policies, is it permitted? So, IND AS 101 says, first time adopter may continue with the policy for the period ended before beginning. Okay. Company can continue the existing accounting policy in respect of this loan over the balance period of such loan. Only for this loan. You cannot, if you are taking a new loan, you should not follow this policy, but for the existing loans, yes. Okay. So now listen. Illustration 16. H Limited has the following assets and liabilities. Almost all adjustments are discussing in covered in illustration 16 and 17. So listen, IND AS 101, illustration 15, 16, 17 and test your knowledge questions you should not miss. All the adjustments are covered in question number 16 and 17. So listen. H Limited has the following assets and liabilities as at 31st March 2011 prepared in accordance with previous GAAP. So they are giving you a balance sheet which is prepared as per previous GAAP. So what are the items in the balance sheet? PPE. 1 crore 34 lakh 50,000. Investment in S Limited 48 lakhs. Trade receivables. Advances for purchase of inventory. Uh, okay, 50 lakhs. Advance to creditors. Advance to suppliers. Inventory. Um, Cash. Total assets. Then VAT deferral loan. What is this? Creditors, short-term borrowing, provisions. VAT deferral loan is actually, it's given that it's a government loan. Then creditors, short-term borrowing, provisions, total liabilities. You have share capital, reserves, cumulative translation difference. So, cumulative, this reserves is the total. It is cumulative translation difference. ESOP reserve, retained earnings, total equity, equity and liability. Oh, sorry. So a balance sheet is given. Fine. The following gap. So this balance sheet is prepared as per Previous gap. Accounting standards, guidance notes, Companies Act. Okay, fine. The following gap differences were identified by the company on first time adoption of IND AS with effect from 1st April 2011. In relation to PPE, the following adjustments were identified. PPE comprise land held for capital appreciation purpose. Cost 4,50,000 was classified as investment property. You know this. You know that investment property is to be reclassified and present separately. It should not form part of investments. It should not form part of, I'm sorry, PPE. So investment properties are to be reclassified from PPE to investment property. Okay, fine. So when you present this 134,50,000 from this, you deduct 4,50,000 and show investment property separately when you prepare the IND AS, first IND AS balance sheet. Okay, understood. Exchange difference of 1 lakh were capitalized to depreciable PPE on which accumulated depreciation is 40,000 was recognized. You have already capitalized 1 lakh exchange difference to PPE. Okay. So is that correct or is that wrong? If you are following deemed cost, if you are taking over the previous gap carrying value, it is okay. Correct. So, okay, fine. There was no asset retirement obligation. What do you mean by asset retirement obligation? Decommissioning liability, dismantling, restoration of site expense. Such item is not there. Okay. The management intends to adopt deemed cost exemption for using previous gap carrying values as deemed cost at the date of transition for PPE and investment property. Okay, fine. There is no adjustment at all. Just take over. 134 lakh 50,000 is the value of PPE. So now show it as 130 lakhs as PPE and 4 lakh 50,000 as investment property. That's it. The company has made an investment in S Limited, subsidiary of H, for 48 lakhs that carried a fair value of 68 lakhs at the transition date. The company intends to recognize investment at its fair value at the transition date. Come on. There is an investment in subsidiary S Limited, 48 lakhs. There is an investment in subsidiary for 48 lakhs. Understood. This 48 lakhs is the previous gap carrying value, maybe at cost. But now they want to measure this investment at 68 lakhs. Is it possible? You should say, as per IND AS 101, a first time adopter may calculate the value of investment either based on IND AS 27 or on the date of transition. As per IND AS 27, you can value cost or value as per measure as per 109, or you can calculate the fair value on the date of transition or the cost, previous gap carrying value. So here fair valuation is possible, which means the investment value becomes 68 lakhs. So there is a gain, there is a change of 20 lakhs. Where do you account that change of 20 lakhs? Of course in retained earnings. So retained earnings should increase by 20 lakhs. Okay, fine. VAT deferral loan. Listen carefully. VAT deferral loan, government loan. What was the provision as per IND AS 101? A first time adopted should do retrospectively if the market rates are available on the date of loan, or prospectively, just you need not split. That's possible. That's okay. On the date of transition, if you're not splitting, it is fine. So VAT deferral loan 60 lakhs. VAT deferral loan of 60 lakhs was obtained on 31st March 2011 for setting up a business in backward region with condition to create defined targets for employment of local population of that region. The loan does not carry any interest. Oh my god, it's an interest-free loan received from government, repayable after 5 years. In accordance with 109, the discounting factor on the loan is to be taken at 10%, being the incremental borrowing rate. Incremental borrowing rate, accordingly, the fair value of loan is measured. Loan is obtained on 31st March 2011. So you measured the fair value of loan on this date's IBR is given 10%. Okay, then you can split. Yes or no? Loan date is 31st March 2011. Sorry. You have taken the loan only on this date. Only on this date, 31st March 11. On 31st March 11 only you have taken the loan. But previously it was recorded 60 lakhs. On this date's IBR is 10%. So you have split it into 37 lakhs. 60 lakhs is the loan, but fair value of loan is 37 lakh 25 528 only. So the difference 60 lakhs minus 37 lakh 25 528 should be accounted as 22 74 472 should be recorded as government grant, deferred government grant. The entity chooses to exercise the option, that is entity chooses to apply the requirements of 109 accounting and 20 share. So you split the 60 lakhs loan to uh, loan 37 lakhs something and balance 22 lakhs government grant. You need to split, but there is no change in the amount. As there is no change in the amount has not changed, so there is nothing to be transferred to retained earnings. Okay, understood. Now, the retained earnings of the company contain the following. ESOP reserve, share-based payment reserve, 20,000. The company has granted 1,000 options to employees, out of which 800 have already vested. Okay. The company followed intrinsic value method for recognition of ESOP charge and recognized 12,000 towards vested options. So, 1,000 options are there. 800 vested options, obviously 200 unvested options. On vested options, expense recognized is 12,000. So on unvested options, expense recognized must be 8,000. Yes or no? If fair value method has been followed, the corresponding charge would have been 15,000 and 9,000. The company intends to avail 101 exemption for not restating the ESOP charged for vested options. They decided not to account because there is an option, right? If the company is encouraged but not required is what given. So we decided not restate this 12,000, but this has to be restated. So ESOP reserve should increase. If ESOP reserve is to increase, the corresponding difference will be to retained earnings. Retained earnings to ESOP reserve. Okay, that's it. That's it. Is it clear? Very easy to understand. For vested, you are not doing any accounting. For non-vested or unvested, you are doing this adjustment from intrinsic value to fair value. Is it okay? Then the company had a non-integral foreign branch in accordance with AS 11 and had a balance of 1 lakh as a part of reserves. On first time adoption of IND AS, company intends to avail 101 exemption of resetting the cumulative translation difference to 0. Is that possible? Of course it's possible. So 1 lakh, that FCTR balance will be nil and this retained earnings will be more by 1 lakh. Prepare transition date IND AS balance sheet of company H showing adjustments to the value of assets and liabilities. See, trust me guys, this question has not yet tested for exam. And it's a good question which can be asked for maybe an 8 marks or 10 marks. So what should I do? You should prepare a table. Table like this. Very easy answer. A table. Transition date balance sheet. First transition date balance sheet. Particulars. Previous gap figure. Adjustment in days. Previous in days. In between, what is the adjustment? So 1, 2, 3, 4. Not numbers. If there you can give, or else 1, 2, 3, 4. Particulars. Previous gap figure. Adjustment in days figure. Oh, easy. Non-current assets PPE. 134 lakh 50. You eliminate 4 lakh 50, so 130 lakhs. Investment property. It was 0 originally. You account 4 lakh 50, so it got set off. Nothing to retained earnings. Okay, fine. Then inventory, no change. Investments in S Limited, you have to give up subheading financial asset, a small heading that it's a financial asset, investment in equity shares. It was 48 lakhs, but you intend to measure this at fair value. You want to measure at fair value. So 20 lakhs to retained earnings. Trade receivables, no change. Cash, no change. Advance for purchase of inventory, no change. So total. Share capital, no change. Other equity, cumulative translation difference you set to 0. So there is 1 lakh to be adjusted to retained earnings. So 20 lakhs gain to retained earnings. 1 lakh also credit balance in the reserve to retained earnings, 21 lakh. Then ESOP reserve was 12,000 plus 8,000. But now it is going to be 12,000 plus 9,000. So expense increased means it's a loss. So 20 lakhs gain plus 1 lakh gain minus 1,000. Okay. Retained earnings was originally 1,79,000. Add 20, add 1, minus 1,000, 20 lakh 99. Okay. The non-current liability, financial liability, VAT loan. It was 60 lakhs, but you should show only at its fair value 37 lakh 25,528. So difference. The difference is accounted as a deferred government grant under non-current liabilities only. Why non-current liability? If condition is not satisfied, you may have to refund. We don't know. So you should show it as under non-current liability. Then trade payables show under financial liabilities. No change, no change, no change. So it's done. It's finished. It's easy, right? Once you are through with the provisions, nothing great. But this is a question which is not asked for exam. So be careful or go through the points and it is very easy. The format, adjustments, okay. Is it clear? Now, um, question number 17 is even more big question, but it is easy. If you can invest time and read, it is actually easy. So I'm reading this question number 17, illustration 17. Shaurya Limited is a company. Okay, Shaurya Limited is a company having its registered and corporate office at New Delhi. 60% of Shaurya Limited's shares are held by Government of India and rest by other investors. This is the first time that Shaurya Limited would be applying IND AS for preparation of financials for the current financial year 1920. Following balance sheet is prepared as per earlier gap as at the beginning. Okay, so as per the previous gap, they have prepared a balance sheet. Balance sheet as at 31st March 18, figures in thousands unless otherwise specified. Equity, old format, equity and liabilities, shareholders fund, share capital reserves, long-term borrowing, long-term provision, deferred tax liability, trade payables. Okay. So many items. Additional information, figures in thousands. All current liabilities include 3,90,000 liabilities to be paid in cash. Expense payable, salary payable, and 60,000 are government statutory dues. See, when you prepare the first IND AS balance sheet, what are the general principles? Recognize, derecognize, reclassify, remeasure. So, based on the previous gap provisions, you need not show a current liability or a non-current liability as financial liability. But here, if you have contractual obligation to pay cash or financial asset, you should show it as financial liability. So here, sorry, other current liabilities should be divided into two: financial liabilities and other current liabilities. Statutory due 60,000 is not a financial liability, statutory due. But balance 3 lakh, how much? 3 lakh 90, right? 4 lakh 50 minus 60. 3,90,000 should be presented as financial liability. So that's it. Yeah, that's it. That is with regard to the first adjustment. Long-term loans and advances. 40,000 loan and remaining amount consists of advance to staff. Long-term loans and advances. So which means asset. Long-term loans and advances 1,50,000. What is the breakup of this 1,50,000? 1,10,000 advance to staff and 40,000 long-term loans and advances. Again, show it as financial asset. If you have a contractual right to receive cash, you should show it as financial asset. Seriously, that's it. That's it. Because from previous gap to IND AS, you need to classify the items as financial asset, financial liability. That prefix is very important. That subhead, that small heading is very important. So you please show it as financial asset. Okay. Other non-current assets of 2 lakhs consists of capital advances to suppliers. What do you mean by capital advances to suppliers? You have given an advance. Okay, you have given an advance to get a capital asset. So there is no contractual right to receive cash. There is contractual right to receive a capital asset. So it's not a financial asset. Okay, easy. Other current assets include 3,50,000 current assets received in cash. Prepaid expense 50,000. Again, prepaid expense will not be recorded as because there is no contractual right to receive cash, not a financial asset, but 3,50,000. Other current assets 4 lakhs. So you will show the breakup financial asset 3,50,000 and other 50. Okay. So balance sheet presentation is what? The first few points. This what with regard to the first few points, you just need to be clear about the presentation. Short-term provisions include dividend payable 2 lakhs. The dividend payable had been as a result of board meeting where in the declaration of dividend was 1718 was made. However, it is subject to approval of shareholders in the general meeting. Oh my God. Without approval of shareholders, without then only it becomes declaration of dividend. Proposed dividend should not be accounted. Only declared dividend can be accounted. So please reverse it. It is wrong. Only on the date of declaration after obtaining the approval it can be recognized as a dividend payable. So reverse to dividend payable debit to retained earnings. Retained earnings. The adjustment should be to retained earnings. Okay. So question is finished? No. Hey. Chief Financial Officer of Shaurya. So always have that patience, always accept the question will be very lengthy. So you are a next step chart accountant. You should practice reading these questions. This type of questions. CFO of Shaurya Limited has also presented the following information against corresponding relevant items in the balance sheet. PPE consists a class of assets as office buildings whose carrying amount is 10 lakhs. So PPE consists of a class of assets as office buildings carrying a value is 10 lakhs. However, the fair value of said building on the date of transition is 15 lakhs. So you can take over as per IND AS 101 deemed cost exemption. You can just take over the previous gap carrying value or fair value on the date of transition. Both are correct. Company wants to follow revaluation model in the first IND AS financial statements. It's fine. You can show the asset at 15 lakhs. So PPE includes 20 lakhs of which office building was 10 lakhs. It is revalued to 15 lakhs means the entire PPE will be increased to 25 lakhs. Yes or no? Correct. That 5 lakhs you can show. Additional 5 lakhs can be shown. Fine. The fair value of intangible assets estimated is 2,50,000. However, management is reluctant to incorporate the fair value changes in the books of account. They don't want to adjust that change. It's fine. Previous gap carrying value can be taken over. Yes or no? You need not make the fair valuation. Previous deemed cost exemption is availed. Perfect. Then Shaurya Limited had acquired 80% of shares in a company, Excel Private Limited, few years ago, thereby acquiring control upon it at that time. Shaurya Limited recognized goodwill as per erstwhile AS is 14 by accounting the excess of consideration paid over net assets acquired on the date of acquisition that they have recognized as goodwill. Fair value exercise was not done at the time of acquisition. So at that time, AS 14, they have not done fair value exercise. And so there was a business combination and they have recorded goodwill based on the previous values. So what are you trying to say? Is it compulsory that this business combination has to be retrospectively accounted? Is it compulsory to restate business combination or do retrospective business combination accounting? No, it's an option. If a business combination is restated, all the subsequent business combinations have to be restated. That's it. So it's not compulsory. Question is the adjustment is finished. So what we can do? Nothing. ഒന്നും ചെയ്യണ്ട. You need not do anything. Trade receivables include an amount of 20,000 as provision for bad debts measured in accordance with previous gap. So there is 20,000. Trade receivables includes provision for bad debts 20,000. Now as per latest estimates using hindsight, the provision needs to be revised to 25,000. Estimates. Estimate. Previous estimate was 20,000. But as per the latest estimates using hindsights, now you have some additional information. So the estimate should have been 25,000. Should I take the estimate provision for bad debts as 20 in the first Ind AS balance sheet or 25? Very 20. Perfect. Shall adjust in the next year. Correct. If this was error, then it could have been recorded. It was an error actually. We typed, actually we wanted to type 25,000, but it was an error. So it was a mistake. If it is clearly given, okay, fine. Otherwise, you will take over this 20,000 and make the adjustments in the subsequent balance sheet. Very good. So 20,000, no adjustment. Company had given a loan of, again, loan, government loan. No, this is not government loan given. Sorry. The company had given a loan of 1 lakh to an entity for a term of 6 years, term of 10 years, 6 years ago. So 6 years ago, we have given a 10-year loan. So 4 more years you have. Transaction cost incurred separately. Fine. The loan carries an interest rate of 7%. Principal amount is to be repaid in equal installment over a period of 10 years at the year end. Interest is also payable at each year end. The fair value of loan as on the date of transaction is 50,000 as against the carrying amount of loan which at present amounts to carrying amount of loan is 40,000. But the fair value of loan on the date of transaction is 50,000. Okay, fine. However, Ind AS 109 mandates to recognize interest income as per effective interest method after adjustment of transaction cost. Okay. Management says it is a tedious task in the given case to apply EIR with retrospective effect and hence reluctant to apply the same retrospectively. Now I want to remember what is the rule regarding measurement of financial asset, financial liability. Financial asset, financial liability can be retrospectively accounted if retrospectively accounted only if EIR at that time, that loan were raised 6 years ago, right? EIR at year 0. That is at the time when you have given loan 6 years back. If the EIR is available, then you can go. If it is impracticable to do so, no need to adjust this. That is the rule as per the standard. Yes or no? That is the rule as per the standard. So, should I do retrospective accounting or should I do the fair valuation on the date of transition? If it is practical, if information is available, you can go for retrospective. or else prospective. Only on the date of transition you need to do, which means now the carrying amount of that loan is 40,000, but fair value on the date of transition is 50,000. You just need to measure it at 50,000. Additional 10,000 should be charged to or adjusted in retained earnings. Today you need to do. Retrospective is not required to be done because maybe it's a tedious task, maybe cost is more than benefit. No need to do this. Are you clear? Hmm? Do I need to explain a point? Is it okay? Yes. Now, in the long-term borrowings, 4,50,000 of component is due towards state government. So this is what government loan. 4,50,000 of component is due towards. So in the total long-term borrowings, 4,50,000 is a government loan. Interest is payable. Interest is payable on the government loan at 4%. However, the prevailing rate of interest at present is 8%. Fair market value of loan standards 4,20,000 as on the relevant date. Okay. So 4,50,000, very important, there can be a confusion. 4,50,000 is the loan amount. This loan amount, actual interest is 4%. The market rate of interest as on the date of loan is given, or market rate of interest on at the date of transition is given. Market rate of loan on the date of transition is given or only on the date of transition. So can you split this? Do you need to split? That is the question. No, you should not split, correct. So can I show you the provision once more? Government loan, because here usually there is a confusion. In the previous question we split, in this question why we are not splitting? I'm sure you're clear with this, but still let me show you that point once more. Please read this. Government loan. A first-time adopter shall apply the requirements of 109 and 20 prospectively to government. Already if a government loan is existing, 109 and 20 needs to be applied only prospectively. Shall not recognize the, don't split, shall not recognize the corresponding benefit of the government loan at below market interest as a government grant. Shall not recognize 4,50,000. You split it as 4,20,000 and 30,000 government grant calculation should not be done. If the loan is existing at the transition date. Then when should I do this? Yeah, that's what we have read this before also. An entity may apply retrospectively if a loan is existing, provided that the information needed to do so had been obtained at the time of initially accounting for that loan. On that date of loan, if you have the information, you could have split it. Are you clear? In the question number 16, the date of loan was 31st March 31st March 11, which is the date of transition itself. This is the date of loan also. Then you can split. Are you understanding the difference? Are you clear? I hope it's clear. Yes. Now, what is the next point? Next adjustment. Okay. Under previous gap. So this was loan adjustment. Under previous gap, the mutual funds were measured at cost or market value. Investments were measured at cost or market value, whichever is lower. I told you should say it as cost and market value, whichever is lower. Because previous gap, it is investment. Investments should be measured at cost and market value, whichever is lower. Under IND AS, the company has designated these investments as FVTPL. The value of mutual funds as per previous gap is 2 lakhs. However, the fair value of mutual funds on the date of transition is 2,30,000. So investments can be measured at fair value. So fair value increase is there 30,000. Originally it was recorded only at 2 lakhs. So 30,000 increase is there. So 30,000 increase the value of investment, corresponding adjustment to retained earnings. Okay. Ignore separate calculation of deferred tax on the above adjustments. Thank you. Otherwise, you could have taken we have to take the carrying value of all asset with the tax base. So new carrying value versus tax base, we need to calculate taxable temporary difference. Carrying value of asset is more, TTD. Carrying value of asset is less, deductible temporary difference. Ulta is the case for liabilities. We had to do the calculation, but they are telling that you ignore. Thank you. Assume that the net deferred tax income is 50,000. Oh, out of this, there is a deferred tax income. Assume the net deferred tax income to be 50,000 on account of IND AS transition adjustment. Prepare transition date balance sheet of Shaurya. Show necessary explanation of for each item presented by CFO in the form of notes, which may or may not require. So give the notes for all the items. If you have adjusted and not adjusted, also give a note. So transition date balance sheet. I'm quickly getting to this transition date balance sheet. So deferred tax also has to be adjusted. You should give 4 columns: particulars, previous gap, transition IND AS adjustments, opening IND AS balance sheet. Non-current assets, PPE. It was 20 lakhs given quickly. You remember there was a revaluation adjustment of 5 lakhs. 25 lakhs. So this 5 lakhs will be adjusted in retained earnings. Goodwill, no adjustment because no information. They are not restating, no retrospective calculations. Intangible assets, they have given the fair value, but they intends to show it at book value, so no adjustment. Then financial asset, other loans and advances, investments, you have to show it as financial assets. Investment 5 lakhs. Okay, some investment. Loan, there's a loan given 40,000, but as per the loan given 10,000 increases there. Okay, increase 50,000. Then they don't want to do retrospective calculation. Fair value on the date of transition is computed as 50,000. Ah, okay, fine. Other financial assets, no change. Other non-current assets, capital advances is not a financial asset. Current assets, inventories, no change. Then you should show financial assets, investments. There is an increase of 30,000. Trade receivables, no change. Cash and cash equivalents, no change. Other financial assets, other current assets. So adjustments are given for very few items. Okay, share capital, no change. Oh, but other equity, there is a change. What is the 7 lakh 90? That so there is in 5 lakhs from PPE itself. 5 lakhs PPE, 30,000, this 10,000. We'll do the calculation. Then borrowings, government loan has not changed. Provisions, not changed. Even provision for bad debts not changed. That is why debtors, trade receivables remain the same. Deferred tax, they are telling deferred tax income means liability should reduce or asset is to be created. Net off liability we reduced 50,000. Trade payables no change. Other financial liabilities no change. No change. What is this provision 2 lakhs reversed? Ah, that is towards that dividend payable reversed to retained earnings. Correct, correct, correct. So this 7 lakhs is 7 lakh 90 is 5 lakhs. Okay. Asset increased 5 lakhs. An investment increased 5 lakhs. Again, a loan increased 5 lakhs. Dividend payable reversed and 50,000 deferred tax income. 5 lakhs plus 5 lakh 30, 5 lakh 40, 7 lakh 40, 7 lakh 90. Okay. See, are you clear with this? And for each item, they have given a note. So it's a quick discussion only. Are you clear with this? So if you're okay with this, question number 16 and 17. Now it is with regard to this test your knowledge questions. Say, see, all the test your knowledge questions are discussing in another YouTube video. The link of the same I'm putting in the description box. So just go through that 31 minutes video because we are discussing in detail all this theory questions. So that's it with IND AS 101. Happy learning. All the best.